Yeah, good afternoon. Welcome to Next Gen Professional Associates. Right. In today's class, we shall actually continue with what we are doing in our previous lecture. Right. So in our previous lecture, we've been able to look at this particular question here. Right. Of which, when we are to determine, the question says that we should evaluate the financial viability of this project class. Now, we have we have we have done the sales and even the variable costs. Now we need to check which other costs do we have from there. We need to consider the relevant costs that will be relevant to the project, right? We need to consider the relevant costs that will be relevant to the project class. Now we have considered the variable costs class. Now we have considered the selling price, the sales, right? Now, fixed costs, right? Now, you can see here that fixed costs are expected to be 900 are expected to be what? 900 naira, 900,000 in year one, rising by the rate of inflation of a rate of inflation in the subsequent year. Class, the question now is, what is the rate of inflation, right? What is the rate of inflation? And let me quickly scroll down. We have a place whereby we're told that the inflation rate, you can see that the expected annual rate of inflation in the country is located is located is to be 4% in year one and 5% in year two and year. So we have to start it because they've already given us the fixed cost for the first year. So they now say it will rise in the subsequent year by the inflation rate, right? So the inflation rate is 5%. Now we quickly move to this part. We quickly move to fixed cost. Fixed costs. Okay, right? So year one fixed cost. What is the fixed cost there? What is the fixed cost there? What is the fixed cost? Class, what is the fixed cost? 900,000, right? The fixed cost is 900,000, right? Hello? Hello? Am I the only one in this
Yes, it's
class?
900,000.
Okay, 900,000. Okay. So if the fixed cost is 900,000, we move on and it will increase by the rate of inflation, right? Which is 5%. The first year will be 900,000 and they say it will rise subsequently. Year two equals to, so we need to raise this 900,000 times, it will raise by 5%, right? From year two to year four. So that is 1.05. So what do we have? Then the next one is, please give me figure, please. We need to be very fast in this question. We still have some other things to do, please. Where is this?
1,350.
Yes, sir.
Okay, thank you.
Yeah.
So
So the
one, yeah, 1,350, right? 1,350,
Yes,
1,350, like this. Is it like this?
no, no,
yes,
no,
yes, sir. 1,350.
Okay, is it 1,000? I don't understand. Is it one
no. It's
million
not
three
correct.
fifty?
It's not correct. It's 945,000.
1,000.
945,000. Mr. Moses, I beg now. That is fine.
Sorry. 945, sir.
It's fine. 1.05, right? Now we in some question they will tell you that year two will be 50%, year three will be this so percentage. Please, what do we have? Year
Year
four.
three,
992.
9 to 250.
Okay, I'm coming. 9 2
992
9 what?
250.
9, okay,
250.
992
2.
250,
Yeah.
right?
Yeah.
Okay, good. Thank you. So next, we can have this 992 250 times 1.05. So what do we have?
1,041,862
1,041,862
naira 5 kobo.
865, right? So 1,418,000 like this.
No. 1,041,041.
Okay, 041, right?
Yeah.
And what's 041?
862.5.
862. Okay.
Point five.
Okay. Okay, 0.5 cover. Okay, that's fine. So we have actually inflated our what? The fixed cost. Is that not so? We have inflated the fixed cost, right? We have inflated the what? The fixed cost. Now the next thing, after we've inflated the fixed cost, we need to check from the question given to us. We've already inflated the fixed cost. We've done the sales, right? So which other one do we need to inflate? Now, don't forget that we have the initial investment to be what? To be 16 million. If the initial investment is 16 million, SCP will also need to make an immediate investment of 1,025,000 working capital. The working capital will be increased annually at the start of each of year 2. For each of year 2 to 4 by the inflation rate, and is fully recovered at the end of what? At the end of the project life. You can see that the working capital, right? We also need to make an immediate investment of this, and the working capital will be increased annually at what? At the rate of each of years, year 2 to year 4, by the inflation rate. Now, which means that if we are to use what is it called, working capital annually, so our working capital in the first year will be 1,025,000 1,025,000 naira. Is that also in the what? When you want to start a business, you need what you will use to run the what? What you will use to run the what? Business. Is that also? And that is why it is called capital, right? So, the meanings, please.
Now, why are they use extra food?
You say? Okay, sorry. So, so now let's come again. So we also need to make an immediate investment of this in working capital. The working capital will be increased annually at the rate of what? At the rate start of each of the year 2 to year 4 by the inflation rate. Now, this is to tell us that your working capital will increase year 2 to year 4. Is that not so? Now, class, definitely we need to have a working capital at what? At year 0. Is that not so? Class. So the working capital at year 0 will still remain 1,025 what? 25,000. Is that not so? 1,025,000. But what will happen to year 1? Because this question is supposed to it will from year 1 to year what? to year 4, but it is not actually stated. The working capital will be increased annually at the start of each of the years. Okay, at the start of each of the years. So 2 to 4. Okay. So definitely at the start of each of the years, class, at the start of each of the years, right? So our year 0 will be 1,020,000. You can see that I needed to read that question again for me to understand what they meant in this question, right? So therefore, and that is how it is. You just need to understand, right? Now, working capital. So we can say working capital, working capital, right? Year 1, year 0, sorry, because when you want to start, it will be at year 0, right? And it is 1,000,000, 1,000,000 what? 25,000, right? 25,000. So year 1. So we need to increase this based on the inflation rates. Now, class, based on the what? Inflation rates. Now, let's quickly check, because they say it will increase on each of the years. Now, the year 1 will be 4%, class. So, which means that the working capital will increase 4% in year 1 and 5% in the what? In the subsequent year. Now, don't forget what they mentioned there. They said the working capital will increase annually at the start of each of these years, 2 to 4, by the inflation rate, and is fully what? Recovered at the state of each of the years. So years 2 to 4. So what will happen to year 1? So at year 0, when you want to start, you say, oh, this is what you will use to. So you start to make use of this working capital from year, it is not from year 0, it is from the first year, which is what? From year 1, class. Are we together? The question did not actually stay. You can see the way they actually twist this question now. So we can have 4%. Please increase this by 4%. 1.04, right? So what do we have?
1,066,000.
1,066,000. Like this?
Yes.
Okay, 1,066,000. Year 2. So what do we have in year 2? 1,066,000. Right? They say it will increase on a yearly basis. Is that not so? Based on the annual inflation rate times, what is the inflation rate? 1.05 for the year 2. What do we have?
1,119,300.
1,119,300. So what will happen to year 3? Coming. Okay. Year 3. All right. Year 3. 1,090,300 times.
No, you didn't get it well. It's 1,119,000, not 1,019,019.
Okay, 119. Okay. Okay. So what do we have? So what do we have times 1.05? What do we have here?
1,175,265.
1,175,265. Right? Year what? Year 4. 1,175,265 times 1.05. What do we have?
1,234,028 naira.
1,000,000
234.
234 okay, 1,234
028.
028. Now, class, this is the inflation rate that the question says that the working capital will increase. All right. Now, what will be the changes? Because we need to reflect what will be the changes in working capital. Now, you need to understand this. When you say this thing increases, what is the changes? What is the increase? What is the changes in that particular working capital? Don't forget that at the end of year 4, they have to recoup back this what? Investments, which means that at the end of the year 4, they have to do what? Recoup back your investment. So now, let's do something quickly. Let's do something quickly as changes, because when you are doing evaluation of a business, there is what we call changes in working capital, right? So let's say it is from year 0, year 1, year 2, and what? Year 3. Okay, year 3 and year 4. Okay, good. So now, at year 0, class, at year 0, the working capital, let's say the working capital that the working capital will be at your year 0, class. You will start to use the working capital from year 1. Now, at the end of year 4, you will recoup back your money. So we are not supposed to even do this, because at the end of the year, at the end of the what is it called, the project, you will recoup back your investments, class. So which means that year 4 will be the year at which they will recoup back their investments. Now, if we now go by this, I just want to show us how it works, right? Now, at year 0, at the first year, the working capital is 1,025,000. This is the working capital. Then year 2 is 1 million. Please copy the figure, be calling the figure so that I will not be 1 million what? 066 thousand. Okay, thank you. So what next? The next one is 1 million 1. Okay, 1 million what? 1 million 1.
300.
Okay, thank you. 119 300. Okay, thank you. So the third year is 1 million. So it is the last year that they will recoup, because it is actually stated in the question. Something, I'm still waiting for your message. Please drop message on the platform. 1,175,265. Now, class, we now have a changes in what? In working capital. Changes in working capital. Right? Changes in what? In working capital. Now, what the changes in working capital means that at your year 0, your working capital will be 1,025,000 that you will use to start the business, the project. Now, what will be the working capital in what? In year 2. Now, look at this, what is happening in year 2. When you look at this year 2, you will see that it increased from 1,025,000 to 1,066,000. Class, what is the increase? The difference between the 1,025,000 and 1,066,000, what is the increase? What is the changes? What is the difference? Quickly, class. The difference between 1,025,000 and 1,066,000, what do you have?
1,000.
What do you have?
41,000.
41,000, right? 41,000 is the increase. Is that not so? So now, between year 1 and year 2, what is the increase? You minus 1,666 minus, when you minus it from 1,119,000, there is an increase in working capital. If there is an increase in working capital, it will reduce your cash flow. That is why we have to put it in brackets. Plus, that is why we have to do what? We have to put it in what? In bracket. So what do you have? What is the difference?
53,300.
53,300. 53,
300.
53,300. Okay. Now you can see this one will reduce your cash flow, right? Is that also? Now the next one is, what is the difference between 1,119,300, and you can see from 1,119,000, is that also, to this, is it an increase? There is a decrease in it. Is that also? Class, is that not so? Is there not decrease? Or, oh, there's an increase. Okay, 1,119,000. There's an increase. Class, are we still together? So,
Yes.
hello?
Yes.
Okay,
Yes.
Yes.
okay. Thank you. Because I'm looking at the figure, I see 119 is higher than 175. So, what is the difference, class?
55,965.
55,965. So, it is at the end of this year they will now recoup back their investment. Class, when you add these three together, what do you have? Add these three together, what do you have?
150,265.
One,
150,265.
1,5, we call it 1,550, 150,
265.
265.
265.
Okay, 150,265. That is what you have for the increase, right? 150,265. That is 1,000,000. 150,265. Okay. That's fine. So now, at the end of this year, what do? You will recoup back your what? Investment. How much? What is the working capital you use? Is 1,025,000. So the 1,025,000 will become a positive to you at the what? At the end, at the end of the year, because you have to recoup back your what? Your investment. And that is why it will be a positive. It will be an inflow at the end of the what? At the end of year 4. Class, am I communicating? Hello, class. Class, am I communicating?
Yes, sir.
Okay. But let's now do something again. 1,025,000 plus 41,000 plus 53,300 plus this. What do you have? Plus, add everything like this together. What do you have? What do you have? Class, I'm waiting.
1,175,265.
Okay. Come. I want you guys to understand something in working capital. That's why I'm taking my time like this to explain. Right? Oh, you will understand it. Even if you do not understand it, I will explain to you. You must understand it. Right? You must do what you must understand. So what do we have? What? See, now let me quickly explain something here. The last figure is not supposed to be 1,025,000. Do you know why? Because at year 0, you use 1,025,000 to run it. From there, the working capital increases by 41,000 in year 1. In year 2, it increases by 53,300. In year 3, it increased by 55,965. You need to add all this money that you use in running this business together so that it will give you your inflow. For instance, now, I may use 100,000 to run next gen at what? At the beginning of January, right? Every January, every week, probably I'm spending 5,000 naira on data. Let's say 5,000 naira on what? On data. That 100,000 naira, I will add it with 5,000 naira every week. So I will add everything together. At the end of the 4 months, I will tender it that this is what I spend on what? On data. And that is what? Working capital. So now we need to add all this together, right? You add all this together. So what do we have, class? 1 million what?
175,265.
1,175,265. It becomes an inflow to you at the end of the what? The 4th year. So we are done with working capital, right? We are done with what? Working capital, class. And they already said it that it will be recoverable. But sometimes they may not even state it that it will be recoverable. But you should know that working capital will be recoverable at the what? At the end of the what? At the end of the year. At the end of the project year. Now, the next thing we need to adjust is SCP will also incur one-off marketing expenditure of 1,500,000 post-inflation after the launch, right? After the what? After the launch, right? After the launch of Nucleo. Is that not so? After the launch of what? Nucleo. Rachel,
Yes,
Rachel,
sir.
I'm with you.
Yes, sir.
I'm with you.
Yes, sir. Why did we do working capital for year 4?
Why do we do? Well, no, we didn't do working capital. We didn't increase it. We did not increase the working capital for year 4. You can look at it. We didn't increase it. Now, when we come here, it is the period the project will last for 4 years, right? Now, each of this year, it is what you incur. It will be in an outflow. At the end of that particular project, Rachel, you will recoup back your money you've been spending on data on a weekly basis. And I've stated an example, and that is why it will become an inflow, because the question says that it will be recoverable at the end of the project. It is practicable. Rachel, you have a business, right? And that you start this business with 100,000 naira. And now every month you incur 50,000 naira for data. Now, at the end of the year, you will remove all those money you use in starting that project, starting that business. You will remove it. That one will become your inflow to you first. That, oh, this is the money I use, so let me remove it for. So that is why at the end of the 4th year, you will now add all what you've incurred over the months, over the years. You add it together, it automatically becomes your what? Your recoverable, your inflow. Rachel, am I communicating? Do you get? I can't hear you.
Yes, sir. I'm
Okay, okay,
getting it. Thank you, sir.
okay. So that's why it becomes an inflow, right? Now, the next thing we need to talk about is what? Is the marketing expenses. And the marketing expenses was stated that it is it is post-inflation, right? The marketing expenditure can be assumed to be made at the end of year 1 and be tax allowable expenses, right? It is allowable, it is a relevant cost, right? Which is what 1 million. So we don't have any issue with that. It is post after they've considered inflation, right? Now the next thing is the tax. Let's say FCP pays company annual tax. This is payable in the year that the tax liability arises. Fine. Tax allowable depreciation is available at what? 20% on the investment in non-current asset on what? on a reducing balance. Don't forget that on a reducing balance method. Now, a balancing adjustment will be available in year 4. The realizable value of the investment at the end of year 4 is expected to be 0, which means that when we want to sell this investment, the investment did not have any realizable value. We don't use them higher. It's 0, class. Now, instead of charging depreciation, you will now need to charge capital allowance because it is on what the asset is on reducing balance what method. So with that, the relevant tax authority will now grant a tax, what we call tax savings on that particular what on that instead of depreciation, it becomes what capital allowance. And that capital allowance, there is a tax savings that the company will be enjoying instead of what the depreciation, because depreciation does not allow. Is that not so? It does not what allow because of it is not uniform. Another person will use straight line, another person will use what reducing balance method. So we need to do to calculate our capital allowance on what on a reducing balance method. Let's say allowance capital allowance right capital allowance capital allowance. Now, if you want to calculate your capital allowance, the project is for how many years? It's for 4 years, right? So you can have, let's say, your years, the years of the project, yes. Then you can have, let's say, the items or the cost, or let's say the items, right? You can have the items. Then after the items, what again can you have? You can have capital allowance, which is CA. CA means continuous what assessment new. Write it in full. Capital allowance. Is that also? Then tax savings. There will be a tax savings on capital allowance. Tax what? Tax savings. Then we have what we call years what? Year due. Years what? Due. So we can let me put this. What's this one? So we can have what? Tax due. Now, the first one is you need to start from coming on a yearly basis. Is that not so? Year 1. So the asset is what? 16 what? Million. The asset is what? 16 million. Quickly we can have, since the asset is 16 million, year 1, the cost of the asset is what? 16 million. Let me just put this here. Becoming okay. The cost of the asset is what? Is this okay? Which is year 1, right? So the cost of the asset is year 1, which is 16 million, right? So we charge capital allowance instead of depreciation, CA. So what is the percentage for the capital allowance? What is the percentage, class? Because they say it's reducing balance. Is that not so? So what is the percentage for the capital allowance? Tax allowable depreciation is allowable for investment for how many percent? 20% on what? 20% on what? On reducing what? On reducing balance, class. 20% on what? On reducing balance. So we move on to that part now. This is 20%, right? 20%. So please charge. Please 20% of this quickly. 20% of this. Hello. Where is
3.2
what is the 20%?
million.
Okay, 3.2. Thank you. 3.2 million. So minus it because it's reducing balance method. Plus, if it is straight line method, you don't need to do all this reducing balance method, blah, blah, blah. So you just charge the 20%, just charge the 20% on the asset and charge your tax savings, whatever the amount. You see how we will do it. Because this is straight line method. So we need to reduce it based on that. So the capital allowance is what? Is 3,200,000, right? Now, don't forget that the tax savings, how many percent is the tax? How many percent is the tax? How many percent first? Tax is 25% class. Tax is what? 25%. Tax is 25% class. So we can now come here and say our tax is what? 25%. Now, so the tax savings will be on capital allowance. So please, class, charge 25%, 25% of 3.2 million. What do you have? 3.2 million. What do you have?
800,000.
Okay, 800,000. Let me just put it here. 800,000. Thank you. Now, what do you use to do your tax savings? Is 25% of the capital allowance. Now, the tax due class, sometimes they may tell you that the tax is on arrears, or yes, in arrears, or year one will be paid in year two. Oh, the tax is not paid in the year which profit was made. Is that not so? Now, in this question, we're told that the tax liability is being paid in the year at which the profit is being made, right? Now, in this case, in this case, which means that their tax liability will be at what? At year one. And then being they said, oh, it is based on year one will be paid. There's a way they will put it. They will tell you that they've been paid in arrears, which means that year one will be paid in year two. So year one now, you will now put two there instead of one that I'm putting now. Is that not so? So now, what is the difference between the 16 million and 3.2 million class? Because we have told that it is on reducing balance method. Quickly, class, what do you have? What is the difference? What is the difference?
12.8 million.
You say, what is the difference?
12.8 million.
12.8 million. Please, you are not audible enough, please. Can you 12.8 million? Please, can you adjust your mic? Adjust your mic. 12.8 million, right? Now we still charge what? Capital allowance on this, right? Which is what? Don't forget that this will be your tax written down value. Is that not so? This will be your what? Your tax written down value. Okay, let me just put it as tax written down value, right? So you take it to the next year. You take it to the next year, which is year two, right? So your tax written down value got forward. You charge your capital allowance on it because it is on what? Reducing balance method. CA, 20% of this. So what is the 20% of this? Quickly. What is the 20%? Quickly.
2,560,000.
Okay, 2,560,000. Okay. So the capital allowance will be 2,560,000. Please charge 25% of the tax savings. 25% of the capital allowance. What do you have?
40,000.
Pardon?
640.
640.
Okay, 640. Okay, 640. Thank you. So we'll be paid in that same year because the liability is being paid in the year at which the profit is being made, right? Now, the next one is, so okay, what is the difference? What is the difference? Quickly, so that we can take it forward again. So this will be tax written down value. Class, what do you have? What do you have?
$3,240,000.
What do we have? 3 million, 3 million,
10,240,000.
240,000. Okay. Thank you. Thank you. God bless you. So now we still move ahead to this, right? To this part, capital allowance of 20%. So what is the 20% of this? Quickly, what is the 20%? So quickly, what is the 20%?
2,048,000.
2,048,000. Right. So this is 2,048,000. So what is the
Yes,
tax
sir.
savings on this? Eh?
2,000,000
I
and
can't hear you,
48,000.
Rachel.
And 48,000.
Oh, okay,
048,
okay, okay,
sir.
okay, okay. 2 million. Okay, okay, okay. Sorry. 048. Thank you. So what is the tax saving? Charge 25% of the capital allowance.
512.
What do we have? Okay, 512. Just 512.
Yes, sir.
Okay. At year 3, this will be year 3. Now, in the final year, class, what is the difference first? What is the difference? What is the difference? Exclusive, you are not giving me figure. Okay, oh. What is the difference?
8,192,000. 8,192,000.
8, okay, 8,190,000. Now, class, 9 what? Are we together?
9,
9.
2.
Eh, okay, 92. 8,192,000, right?
Yes, sir.
Okay, 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 okay. I don't know what is happening to. I think the network is just. I can't hear you.
Yes.
Okay. So now, in that question now, if you look at it very well, the question says that the realizable value, the realizable value of that particular asset at the end of the year, it will be what? 0. Class, I didn't being the realizable value is given to us in the question. Class, I didn't be the realizable value is given to us in the question. We would have still charged we would have still continued. Now, I explained something in our previous class that when at the end of that year and you dispose an asset, you don't charge capital allowance in the year at which what you dispose that particular what in the year at which what you dispose that particular what asset. You don't charge capital allowance in that particular year. I actually explained that. Is that not so? I explained that. So in this case now, when you look at it, someone will now ask that, why can't you do year 4? If you want to do year 4, you bring this, you say year 4. You can't charge capital allowance on this. Okay, let's say the total is, let me bring this down. Let me bring this down. Let me bring this down. This is the tax season. You can't charge capital allowance in this year because the scrap value, the realizable value is 0. The realizable value is 0. I think the sales proceed is like 50 naira now or 50 million. You cannot compare. Is it balancing charge or balancing allowance? Class, in the year at which you dispose an asset, you don't charge capital allowance in that year, which is the last year. You don't charge capital allowance, right? The only thing you will look for is it balancing allowance or balancing charge? If it is balancing allowance, if it is balancing allowance, there will be tax savings on it. There will be tax savings. Of course, the relevant tax authority will grant you a tax savings on that asset because you make a loss in the disposal of that asset. But if it is balancing charge, you will pay tax, which means that you will include it before you do your profit before you do your profit after tax. You have to include it because it is taxable. Class, am I communicating? I need to confirm that. Am I communicating?
Yes, sir.
Okay. Thank you. Thank you so much. Now, if this is established, class, if this is what established, which means that in the final year, what they have, the tax written down value is just 8,192,192,000. And that is what they have, right? In that particular year. Class, you don't charge anything because the realizable value is nil. I think being they give you figure, you cannot compare if it is balancing charge or balancing allowance. Right? So we are done with this. We are done with this part. So when we want to put, the next thing is to do our financial, to put it in this format, right? To put it in this format when we have year 0, right? We have year 0. I'm coming. Year 0, year 1, year 2, year 3, and year 4. Adding being is a situation whereby the cash flow is the same. Adding being the cash flow is the same. We would have used the other formats of what is it called, to determine the NPV. We would have used the other formats. But since the cash flow are not the same, they are different, right? We will actually get what we'll get there. Class, please ask your question. Unmute your mic and ask your question before we continue. So please unmute your mic and ask your question. And this is what the capital budget investment appraiser is all about, right? You have to make an investment decision. Is that not so? You have to make an investment decision. Class, please unmute your mic if you have questions.
Good afternoon, sir.
Yeah, good afternoon.
Good afternoon, sir.
Good afternoon.
Okay, my question is on capital allowance. When do we if let's say like this we treat it, let's say the project is for 5 years. When do we bring in our scrap value? Is it at the last year?
At the end of the year.
At the end of the year, okay. Then
yes,
we also claim capital allowance. We are supposed to claim capital allowance for the last year of the project, right?
No, we are not. And that is why I've been explaining this. I think I actually explained it that the year at which you dispose that asset is the year end of that particular project, right? Is the year end. In that year end, you don't need to charge capital allowance unless if when you dispose that asset, you have balancing allowance. Balancing allowance is a loss. So when you have the balancing allowance, in the place of, you say, your tax sitting down value divided by the scrap value, class, the difference will give you balancing allowance. Let's say, for instance, balancing allowance. You can now charge 25% on that balancing allowance as your tax savings that the relevant tax authority will give to you because you make a loss in the disposal of that asset. That is one. If you have a balancing charge, we will get there. You will see a question. We will get there. If you have a balancing charge, you have to tax it. There is no tax savings on it because you make a profit. You pay tax. Right? Moses, are we together?
Yes, sir. Yeah.
Okay. So is it clear?
Yes. Thank you very much.
Yeah, you're welcome. So please let me quickly create another link. I think this is 2 minutes. I don't know. Let me quickly create another link so that you can actually join. Okay. Let me